where you made a high early in the year and then dropped into the summer. That sort of unnerved the Fed a bit, by the way, even though they were denying that there was any mortgage problem. And they cut rates in September. You went up into October, marginally beyond prior highs, like beyond the 2000 price high, which had been 1550. And earlier in 2007, you got up to 1575. So you took out even the 2000 high at 1550, the dot-com high, by 25 points. I got 0.5%. And that was the top. So sometimes the stock market labors that way. In other words, it doesn't make its peak and then just boom, it's over. It fools you. I don't know why that is. I think it's the persistent belief structure that a lot of investors have that it always goes up. And therefore, it's hard to kill them. But once you do the initial quarterly momentum damage, in the case of NASDAQ, some annual momentum damage, it says, no, you're through. I think there's also some smart money that has done their homework, and they look at valuations, one asset versus another, and they see that despite silver lagging gold over the last couple of years in terms of its percent gain, it's moving up. Okay, you can't deny that fact. Yes, it's irregular, 2 steps forward, 1 back, or 4 up, 3 back, that kind of thing. Whereas gold doesn't drop as much on drops. But when silver engages like this, and has done this same thing, technically speaking, back in the 79 to 80 move, and also in the 2010 to 2011 move, where silver woke up far more dramatically than gold and engaged to the upside in a startling way. It wasn't startling if you did your technicals right, but it was startling to most people who didn't expect it. And when that happens, people tend to panic into that market, chase it. And when a market is run out of sellers, basically, those who may have wanted to restrain it, okay, and they quit, and suddenly public money comes in chasing it, that's when you get the wet bar of soap phenomenon. I think that's where we are now.
Beneath gold's steady climb, silver has quietly staged a breakout. While its moves are choppy, advancing in bursts, silver has historically exploded after such patterns. In 1979 to 80 and 2010 to 11, silver shocked the markets by outperforming gold dramatically. Now, with smart money positioning ahead of the curve, history may be repeating. A powerful silver rally may already be underway.
I think delusional. It did enough long-term momentum structural trend damage coming off the 2024 highs to argue you're topping it. Okay. I remember vividly back at 2000 dot-com high, which was far less of a bubble than we've got. It was primarily, the excess in that leading sector, internet. We got bearish in January 2000, said, be gone. Okay, well, it dropped into March. Looked like we were right? But then it came back up and a couple of months later made a new high. Didn't go anywhere, just made a new high, enough to say new high, okay. So it looked like we were wrong, but we held to our view that no, you did too much damage in January, February to shrug off. You've broken your leg bones, okay. It labored all during 2000, flip-flopping either side of where we said get out. But it made price chart watchers feel comfy. Because, hey, it wasn't dropping, cool. 2001, it started to fall apart. Took it a while. Similar behavior occurred in that 2007 period where you made a high early in the year and then dropped into the summer. That sort of unnerved the Fed a bit, by the way, even though they were denying that there was any mortgage problem. And they cut rates in September. You went up into October, marginally beyond prior highs, like beyond the 2000 price high, which had been 1550. And earlier in 2007, you got up to 1575. So you took out even the 2000 high at 1550, the dot-com high, by 25 points. I got 0.5%. And that was the top. So sometimes the stock market labors that way. In other words, it doesn't make its peak and then just boom, it's over. It fools you. I don't know why that is. I think it's the persistent belief structure that a lot of investors have that it always goes up. And therefore, it's hard to kill them. But once you do the initial quarterly, we had quarterly momentum damage. In the case of NASDAQ, some annual momentum damage. It says, now you're through.
Just like in 2000 and 2007, momentum fractures are emerging. The Nasdaq's structural weakness mirrors those past peaks where new highs fooled investors before plunges. The signs are clear. Broken momentum and rising rates are flashing red. A deeper correction looms. Investors clinging to the "it always goes up" myth may be walking into a trap they won't see coming.
You pick the time you want to go down, but you're going down. I suspect if you're in the stock market, what you need to watch right now is not the leading Mag 7, which, as I've argued, spread-wise, haven't begun to deteriorate versus the S&P. But watch that bond market, government bond market, and watch that dollar. Because, again, a large percent of the ownership in the U.S. stock market has moved to European hands the last few years. You kick that dollar downstairs about 5 or 10 more percent, and that hits them in the gut by 5 or 10%, even if the S&P stays steady nominally. So that could be a factor in helping to destabilize the stock market, which is usually not the smartest market around anyway. Okay. But I think the central bank right now is not so much concerned about the stock market as they are in debt. Not just the government debt, but they know that certain arenas of the stock market, there is heavy debt-laden situation, commercial real estate being prominent, where they are impacted by the strangle effect of long-term debt rates, 30-year bond rates, for example, which have not relieved them in the least. Since late 2022, long-term rates have been at a choking level, and they're getting no relief. And if you drop bonds much below the low we just saw, which looks like it's being artificially defended, by the way, central bank worried about something. You get down below that level, you could get a downside spike that creates headlines, meaning an upside spike in rates, and destabilizes market arenas that the public hasn't have their eye on right now, like commercial real estate. Because if commercial real estate starts to stumble, it's the borrower. Where's the lender? The banking sector. Okay? So quit watching NVIDIA is our suggestion.
Ignore the tech hype. The real danger lies in debt markets. Commercial real estate is struggling under relentless long-term rates. Government bonds are being artificially supported, but for how long? A drop in the dollar could spook foreign investors and accelerate stock market losses. This isn't about AI. It's about structural debt fragility poised to unleash unintended shockwaves.
It's just, it's lamer than the market. And if you run a spread of the banking sector relative performance versus the S&P, go back 10, 20 years, you'll see, it really never got off the mat. It's gone up with the market, but on a relative basis, it's never resurrected itself. And over the last several days, I've noticed that even the financial sector, the broader financial sector, which includes asset managers, insurance companies, and banks, it's been pretty lame. S&P keeps going up 0.5% a day, and it's just sitting there, bip, 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 like a no heartbeat. So we're watching other sectors. And again, I would watch outside the market. Because what happens in that T-bond market, we've had decades of error. Compounded. You can't keep doing that forever and not pay dues. And, this is why Jamie Dimon is very upset, about the government bond market and the likelihood of recession. I think he's dead on, because technically I agree with what he thinks fundamentally. But watch those other markets like the dollar index. Like I said, 98.35. You close the month below there. As far as I'm concerned, the trapdoor opens. And that could create wave selling effects in the stock market. Which, everybody thinks it's only tariffs now, right? That's the only thing that matters. No, it's not. That's an excuse. And by the way, when markets top like that, the stock market, it's rarely ever the headline you're focused on. It's suddenly, something over there I didn't think about. Oh, this bank went under. What's that got to do with the internet? Okay. Same story here. There's a lot of debt-laden problems out there, not only with consumer debt, but large commercial debt. And you can't afford to hear rumbling coming from that sector due to the stranglehold of high-end, long-end rates, because it will have wave effects. Who cares about AI? You can't afford to have the ambush come from other places. And I think it's about to.
Gold may lead, But miners in silver are about to leap. We're entering a mega boom bust era. When price charts finally confirm what momentum already shows massive breakouts, investors will panic buy into a sold-out market. Mining stocks, undervalued and coiled like springs, could triple relative to gold. This isn't just a rally. It's the start of a generational monetary shift.
I think that you look at SIL and you'll go back a couple years in price. You made two separate highs at around the 50 level in SIL. That we got up to 49 and change recently. Somebody sold just in front of it thinking, I'm going to make a nickel, okay? You know, that's what they made, a nickel. Okay, you get in touch 50 again, you're at a triple top, okay? Now, the old high back in 2011 was much higher, but since then, there have been two other highs. What this is a massive multi-year base, and you're approaching the upper end of the price base. Momentum's already broken out. It says you're going to go through, but prices usually lag to momentum. It's when you go through that level, just above our recent highs, that's when many price charters are going to say, oh, heck, I was wrong. It's not topping. You know, they'll come to the same conclusion about gold, et cetera, et cetera. Something's different this time. I think it'll run, GDX and GDXJ will go take out their 2011 highs in that period of time as well, very quickly. And that's not the end of it. That's just the statement surge, okay? I think there's more to come after the next 3 to 5 months. So I'm not talking about we're making a top in 3 to 5 months. I'm saying we're going to surge in the next 3 to 5. There's a different reality out there now, too. This is a different world we're living in. We don't have a normal boom-bust cycle this time. We have a mega boom-bust cycle. And it's going to have mega consequences that can't just be printed away with the Fed panicking like they do at every bear market. They print, and they don't stop it ultimately until it gets to where it wants to go. And this hasn't even begun. And gold will be the primary beneficiary of that, the gold and its sister and metal and the miners. Right now, if I had to make a bet where the miners will go on a relative basis, and I don't mean necessarily in the next 3 to 5 months, but let's say over the next year or so, they could triple in relative value to gold. In other words, whatever gold does in the next year or so, the miners could do 3 times as much on a percent basis in terms of gain. That's my technical prediction. Now, that doesn't give you a price. It just says you want to be in the miners. Yeah, gold's the mama, but the miners are vastly under their slingshot effect right now. And when they come out of here, and we've seen some evidence of that lately in the price action of the miners. We even get some days where gold's down and they're up. You know, that hardly ever happens, right? I think it's underway. So my emphasis would be monetary metals, but emphasis silver and the miners. Usually when you make a top or a bottom in any market, whether it's long-term or intermediate-term top or bottom, usually when you look at the momentum studies of it, and I don't mean RSI and MACD, those are wet noodle indicators, but we do it structurally with bars just like a price chart. We plot it, and you come up with a different visual picture than what you see on the price chart often. And almost always at a top or a bottom, momentum will have broken out first, and price then gets the message later. I think we're in that phase right now, where suddenly the people looking at price charts suddenly wake up. And, you know, they chase what then is a sold-out market. And everybody wanted to sell did. And now it's a vacuum effect. I think we're there.